This is Professor Fate, faculty member, Finance Department, School of Business and Governance, Ateneo de Davao University. Let's continue with part 2 of Module 1, diving deeper into financial systems, markets, and institutions. Don't forget to like this video, subscribe to the channel, and hit the notification bell so you never miss a future lesson. Let's now talk about derivative security markets. A derivative security is a financial instrument whose value comes from an underlying asset, like a stock, currency, or interest rate. These instruments usually involve an agreement between two parties to exchange a certain amount of the asset at a fixed price on a future date. The main purpose of derivatives is to help transfer or manage risk. For example, they can protect investors from changes in prices, interest rates, or currency values. That's why derivatives are widely used in financial markets, not to own the asset, but to hedge against future uncertainty. Let's go over some selected examples of derivative securities. There are two main types, those traded on exchanges and those traded over the counter, OTC. Exchange-traded derivatives include options and futures. For example, an option might give someone the right to buy Jollibee shares at 200 Cuban pesos. These are available on the PSE, but are still limited in the Philippine market. Futures contracts, like an agreement to buy PHP/USD at a fixed rate next month, can be traded on platforms like PDX or through brokers, though these are mostly offshore in practice. OTC derivatives include forwards, forward rate agreements, FRAs, and swaps. A forward contract could involve a private deal to buy $1 million in 3 months at a set rate, common among Philippine corporations for hedging. FRAs allow businesses or banks to lock in a future interest rate on a loan, helping protect against rising rates. Swaps, on the other hand, involve exchanging fixed and floating interest payments and are widely used by Philippine banks to manage debt and interest rate risks. Lastly, we have securitized loans, like mortgage-backed securities. These are pools of housing loans bundled together and sold as bonds. In the Philippines, these are seen in programs supported by the BSP and various housing agencies. Let's take a closer look at mortgage derivatives, specifically mortgage-backed securities, or MBS. These are created when a bank bundles together many home loans, say 1,000 mortgages, and turns them into one big investment. This investment is called a mortgage-backed security. The bank then sells the MBS to investors, which allows the bank to get its money back quickly and issue more loans. Investors who buy the MBS earn money from the monthly payments made by the homeowners. It's a way to transfer the risk and cash flow of housing loans from banks to the broader financial market. Let's see how derivatives contributed to the financial crisis. Mortgage derivatives played a big role in fueling a credit boom, which drove home prices higher and higher. Banks shifted from a traditional lending culture to more of a trading culture, focusing on selling loans rather than keeping them. At the same time, shadow banks or non-bank lenders grew quickly and took on bigger risks. Risky loans became very common because banks could simply bundle and sell them off without worrying much about whether borrowers would repay. When home prices started falling in 2006, many institutions were left heavily exposed to losses. This chain reaction eventually led to the 2008 global financial crisis. So, should we blame derivatives for the crisis or the way they were used? Famous investor Warren Buffett once called derivatives financial weapons of mass destruction, and during the crisis, that certainly seemed true. But it's important to note that derivatives themselves aren't inherently bad. When used responsibly, they can be powerful risk management tools, helping companies hedge against interest rate changes, currency shifts, and more. The real problem wasn't the derivatives, it was the lack of oversight, poor risk assessment, and the misuse of these complex instruments that caused the damage. Let's now talk about financial market regulation in the Philippines. The main law is the Securities Regulation Code, or Republic Act 8799. This law ensures full and fair disclosure to protect investors and requires that all securities be registered before they are offered to the public. The main agency that enforces this law is the Securities and Exchange Commission, or SEC. The SEC is the chief regulator of the Philippine capital market. It supervises brokers, dealers, and all publicly listed companies. Overall, The SEC plays a key role in promoting transparency, protecting investors, and maintaining the integrity of the market. Let's take a look at financial institutions, or FIs. These institutions help channel money from savers to borrowers, playing a key role in the financial system. There are two main types. Depository institutions, like banks, which accept deposits from the public. Non-depository institutions, like insurance companies, which do not take deposits, but offer other financial services. Many of these institutions receive regular, scheduled payments from customers, known as contractual payments. Examples include insurance premiums paid monthly or yearly, pension contributions paid into retirement funds, loan repayments made to banks or lending companies. These regular payments help financial institutions manage risk and fund their operations. Let's now look at non-intermediated or direct flows of funds. What happens in a world without financial institutions? This is called direct financing, where the suppliers of funds, like investors or savers, provide money directly to the users of funds, like businesses or governments. In this setup, financial claims such as stocks or bonds are issued directly to investors. In return, cash flows from the suppliers to the users. No banks or intermediaries are involved. You can see this clearly in the diagram, where the user of funds is directly connected to the supplier, and the exchange of cash and financial instruments happens between them. Now let's look at intermediated flows of funds. This is how money typically moves in today's financial system. On one side, we have the suppliers of funds. These are households, investors, or firms that have extra savings. Instead of giving money directly to borrowers, they place it with financial intermediaries like banks, insurance companies, and investment brokers. These intermediaries play different roles. FIs collect deposits or premiums. Brokers connect buyers and sellers. Asset transformers turn those deposits into loans or investments. The users of funds are businesses, governments, or even households that need financing. In return, profits or interest flow back to the savers through the financial institutions. Overall, FIs reduce risk, improve efficiency, and help match savers with borrowers, making the financial system work more smoothly. Let's now look at how financial institutions, FIs, benefit suppliers of funds, like households and investors. First, they reduce monitoring costs by keeping an eye on borrowers, so you don't have to. They also increase liquidity, meaning it's easier for you to access your money when needed. FIs help lower price risk, reducing the chance that your investment will lose value suddenly. They also reduce transaction costs, which means it's cheaper and more convenient than lending or investing directly. Through maturity intermediation, you can save for the short term while the FI lends your money out for longer terms. And with denomination intermediation, FIs pool together small savings from many people to fund large loans or investments. Financial institutions, FIs, also benefit the overall economy in several important ways. They help support monetary policy by working closely with the Bangko Sentral ng Pilipinas, BSP, to carry out policies that manage inflation, interest rates, and liquidity. FIs also promote efficient credit allocation, directing funds toward the most productive and promising sectors of the economy. They enable wealth transfer across generations by allowing people to save and invest for long-term goals like education or retirement. And finally, they provide payment services, ensuring that money can move safely and quickly between individuals, businesses, and institutions. Financial institutions face many types of risks that can affect their stability and performance. Credit risk is the chance that borrowers might not repay their loans. Foreign exchange risk arises from changes in currency values, especially for banks dealing globally. Country or sovereign risk comes from political or economic instability in a country that could affect repayments. Interest rate risk happens when market interest rates move in a way that hurts the institution's earnings. Market risk refers to a drop in the value of investments held by the institution. Off-balance sheet risk involves exposures that aren't on the books, like loan guarantees or derivatives. Liquidity risk is the danger of not having enough cash to meet withdrawal or payment demands. Technology risk includes system breakdowns or cyber attacks that disrupt services. Operational risk comes from internal errors, fraud, or process failures. And finally, insolvency risk is when a financial institution's liabilities exceed its assets, threatening its survival. Financial institutions in the Philippines are heavily regulated by key agencies like the Bangko Sentral ng Pilipinas, BSP, the Securities and Exchange Commission, SEC, and the Insurance Commission, IC. The main goal of regulation is to protect the public, ensure stability in the financial system, and prevent failures that could affect the broader economy. Regulators work to strike a balance, allowing financial institutions the freedom to operate, while also making sure they act responsibly. In recent years, the BSP has introduced several reforms to support digital finance, strengthen risk management, and promote financial inclusion, helping more Filipinos access banking and financial services safely. Let's talk about enterprise risk management, or ERM. ERM is a modern approach to risk. It manages all types of risk together as one integrated portfolio, instead of handling each risk in isolation. This approach became more popular after many risk systems failed during the 2008 financial crisis. ERM focuses on building a strong, risk-aware culture across the entire organization. It helps firms see the big picture so they can understand how different risks are connected, not just react to individual threats. In the Philippines, the BSP mandates and oversees ERM for all regulated banks. Banks are required to have multi-layered risk governance, including oversight from the board of directors, the chief risk officer, CRO, and specialized risk committees. ERM frameworks cover a wide range of risks: financial, operational, cyber, and even model risk. It's not just banks. Central market infrastructures like the Philippine Stock Exchange, PSE, and the Securities Clearing Corporation of the Philippines, SCCP, also apply ERM to ensure system-wide stability. Let's now look at the globalization of financial markets and institutions. As more investors participate across borders, the global pool of savings has grown, giving businesses and governments greater access to capital. It's also much easier today to get information about foreign markets, making international investing more accessible than ever. Deregulation in many countries has opened doors to global investors, and international mutual funds allow people to diversify their investments easily and at a low cost. As a result, global capital flows are now larger than ever before. In short, financial markets and institutions are becoming more interconnected worldwide, giving investors greater access, more opportunities, and contributing to the rapid growth of global finance. Let's look at how financial globalization is taking shape in the Philippines. Several major Philippine companies and the government have recently tapped global markets to raise large-scale funding. In 2025, Aboitiz Power issued 20 billion Cuban pesos in retail bonds, with high demand allowing them to raise up to 30 billion Cuban pesos through oversubscription. Also in April 2025, Jollibee Foods Corporation launched $300 million in international bonds, receiving nearly $2 billion in global investor demand. In 2024, SM Investments and SM Prime announced a massive $3 billion Euro medium-term note, YMTN, program, listed via Singapore, aimed at attracting more foreign capital. On the government side, in 2023, the Philippines issued $3 billion in global bonds and 66 billion Cuban pesos in panda bonds, RMB-denominated bonds sold in China. One landmark event was in March 2018, when the Philippines, under President Duterte, issued its first panda bonds, raising around 11.7 billion Cuban pesos. This move reflected a shift toward diversifying funding sources, strengthening financial ties with China, and tapping into lower-cost, non-dollar markets. Right arrow, these examples show how global markets are helping the Philippines attract foreign investment, diversify funding, and support economic growth on a larger scale than ever before. We've now explored the foundations of financial markets and institutions, including their roles, risks, and global impact. As we move forward, we'll shift our focus to something closer to home. Module 2, the Philippine Financial System. Please don't forget to hit the like button and subscribe. Also watch the next video to learn how these concepts apply specifically to the local context, covering our institutions, regulators, and how the system supports economic growth in the Philippines.